Hello friends, welcome to AARDHA. In this video, we will compare mutual funds and direct equity and help you decide which investment path is right for you. First of all, why this topic matters? Because the challenge is many investors confuse mutual funds and stocks, but they work differently in terms of risk exposure, returns potential, skills requires, time commitment needed. Choosing the wrong route can lead to losses or missed growth opportunities. So it is very important to choose the right path. This is like one of the metaphor. Mutual funds is like taking a bus with a professional driver, whereas direct equity is like driving your own car. Here in mutual funds, as this is taking help from some professional, this is shared journey guided by experts, less control but lower effort. But in direct equity, full freedom is there, but full freedom and complete control are there, but total responsibility for results lies on you. Now let's see comparison between these two. Management. In mutual fund, professional fund manager handles everything. Direct equity, you need to research and manage yourself. Diversification in mutual funds is built in because 20 to 50 stocks per fund are present. But in direct equity, you must buy multiple stocks in order to diversify. Knowledge required in mutual funds is low to moderate, whereas in direct equity it is high because you need to study balance sheets, various sectors, charts, etc. Risk level in mutual funds is moderate because uh, it, there are many stocks and many sectors in the same fund. Whereas in direct equity it is high because it is single stock exposure, right? Of course, you can lower the risk by buying multiple stocks from multiple sectors. Then the risk is managed. But you should know that you should have that knowledge. Time required in mutual funds is low. Uh, in SIP you can auto invest also. You can have a mandate to debit monthly amount and buy a SIP, right? Whereas in direct equity it is high. Constant monitoring is needed. Cost in mutual funds is 0.5 to 1% annually. This is known as expense ratio. Whereas in direct equity, you need to pay brokerage plus DP charges per trade. Taxation is same for mutual funds and direct equity. Here, mutual funds should contain majority equity, like 60%. For debt funds, it may vary, but for equity mutual funds and direct equity, it is like for long term, if it is greater than 1 year and if you are getting 1.25 lakhs uh, more more than 1.25 lakh profit, then 12.5% is charged, whereas for short term less than 1 year 20% is charged. Mutual funds are ideal for beginners, goal based investors, whereas direct equity is for experienced investors and active traders. Now let's see when to choose mutual funds. You lack time to research stocks regularly. You want steady long term wealth building. You prefer SIPs and goal based investing, like for retirement, child's education. You want instant diversification without buying 30 different stocks. You don't want to track taxation or corporate actions individually. Best for beginners and busy professionals. Whereas direct equity, you should go for direct equity when you understand stock valuation and financial statements. You enjoy tracking company sectors and market trends. You want full control over your portfolio composition. You are comfortable with high risk and volatility. You can file capital gains taxes and track dividend credits yourself. This is only for experienced investors willing to commit time. Now let's break some common misconceptions. With direct equity always gives higher returns. Reality not true without research discipline. With mutual funds are always low. Returns are always low. Some mutual funds beat market fell long and chosen well. Which mutual funds are always safe? Equity mutual funds can fall 20 to 30% in crashes and even more. Stocks always outperform mutual funds. For most retail investors, disciplined mutual funds do better than stocks. Now let's see what is the recommended strategy. See, keep majority of your amount in mutual funds if you are a beginner, like 80 to 90%. And if you want to go for equity, only go with 10 to 20%. That too, if you can track regularly the stocks you bought. Now let's have a quick summary. Mutual funds are guided route, well diversified, low effort, beginner friendly, whereas direct equity gives you full control, but with higher risk, higher effort, and expert level knowledge. Choose based on time, knowledge, and risk appetite, not hearsay. This is a disclaimer that we are not SEBI registered. This video is for educational purpose only. Thank you.